Well, to Europe now, and the Greek gods are still taking a back seat. The Eurozone's finance ministers managed to snatch defeat from the jaws of victory by imposing extra terms to the Greek bailout late last week. Greece's politicians did manage, finally, to pass the proposals today. But the rioting outside the parliament shows the country's very social fabric is under strain and the country even closer to the euro exit. Well, I'm joined live in the studio by Russ Koesterich. He's the Global Chief Investment Strategist for BlackRock's iShares business. Russ, welcome.
Oh, thank you.
Greece in riot mode. Austerity is killing the economy. I'm just looking at some of these figures. Last year, the economy shrank by 6%, and the IMF now fears it's in a downward spiral of fiscal austerity, falling disposable incomes and depressed sentiment.
I mean, this is the challenge where you have much austerity. You're writing down the face value of the debt, but the problem is that the economy is contracting at the same time, and it makes it much more difficult to stabilize the debt to GDP ratio when the GDP keeps shrinking.
Yeah, I mean, you've got these, I'm just looking at some of these, they're crazy figures. 60,000 small businesses have gone bankrupt, and you wonder why they're not getting any tax revenue.
No, I mean, Greece is in a very difficult spot, more so, and it's very different than, I think, the other countries in Europe in the sense that you have an economy that is contracting dramatically, you have major austerity that has to be imposed, and it's not clear at what point this economy is going to become competitive again. What's
it got to take, in your view, for confidence to be restored in Europe? Because Portugal's wobbly as well.
Portugal is. Now, what you've seen over the last 6 months is really a divergence between Portugal and the other southern European countries and Ireland. The rates there have soared, and I think there's a similar concern as you have with Greece, which is that even if you can impose the necessary austerity, is the economy competitive enough? Is it strong enough in its fundamentals to start to grow again in a reasonable amount of time?
So what would you like to see now?
Well, I think a few things need to happen. First of all, there have been some positive developments. You have seen the liquidity concerns we had about the European banks. Those have been mitigated as the ECB is providing more liquidity. You've seen the Italian and Spanish bond yields come down, which is also representing progress. What has to happen is more political progress, more fundamental reforms in the large European countries of Spain and Italy to really demonstrate to investors that these countries are different and that the issues that are really plaguing Greece are not going to affect them in the same way.
So if that can happen, we may be staving off a default.
Well, again, whether or not you're going to be able to stave off a Greece default, I think is very much an open question. But the good news is Spain, Italy, Ireland, these are economically viable economies. If you do implement the necessary reforms, they can grow out of their debt.
Over the Atlantic, you're still quite pessimistic now about the US avoiding global recession. I think you're now 30% chance for a double dip. Why is that?
Well, the issue in the US is a little bit different. And I'm less concerned about the US in 2012 than 2013. Because of the deleveraging of the U.S. consumer, because of the fact that the consumer is having to correct their household balance sheet, there's not much in the way of personal consumption. As you know, the U.S. economy is driven by personal consumption. The danger for the U.S. economy is next year. We're in an environment where the economy is growing below trend, let's say about 2%. You have a very massive tax increase, which is scheduled to happen. You've got very large spending cuts scheduled to happen. Together, they equal about 3 or 4% of what economists call fiscal drag. If you apply 3 or 4% fiscal drag on an economy that's only growing 2%, you're going to raise the likelihood of another recession in 2013.
So leading your investment strategy, I understand, are the cash countries?
Yes. So this is an acronym we've created for the smaller developed markets, and it stands for Canada, Australia, Switzerland, Singapore, and Hong Kong. And the basic investment theme is if you look at Europe, the U.S., there are no lack of troubles. Japan has been a multi-decade problem. Many of the smaller developed countries, like Australia, came out of the GFC in a much better condition, with less debt, with less traumatized labor markets, and generally they're trading at very reasonable valuations. So these are countries we'd like to overweight within an equity portfolio.
Nice to see Australia in there. Russ Koesterich, thank you very much for joining us.
Thank you.